How's it going, everybody? It's Jason Will with Impact Agent University, coming to you live with a new series called The New Normal. And we're going to be discussing interest rates in 2019 and beyond. But what's the new normal when it comes to interest rates? Are we in that boom or bust economy that we were in the 2008, 2009 crisis? So let's look at what happened. We saw interest rates rise considerably this fall. And, in that kind of peak season of adjustment in December of 2018, it had an impact on showings. It had an impact on inventory because showings were down in the South, where I'm in the Southeast region, around just under 11%. So when showings decrease, that's obviously a decrease in buyer activity, which means there is not that great or as great of an incentive for sellers to go to market. They already don't want to go to market, during the holiday season anyway. So where are we at right now? So we are in the mid fours in terms of interest rates right now. And most of the experts are predicting in 2019 that we're going to go up to somewhere in the 4.6 to 5.1 range. Realtor.com is actually the highest right now, predicting the mid fives, but they're the only one. The majority of folks, including folks in the federal government, are predicting under 5%. They're going to remain under 5% throughout 2019. So what does this mean to the consumer? It affects more than just home sales. It affects the economy. It affects how many people are buying automobiles. So all this stuff is very, very relevant. And we should know, we should recognize that, the housing market is really the backbone of the U.S. economy. But you start to look at this, pre 2018 or 2008 rather, we were, in that 6% interest range. And so people look at 4.5% and they're like, wow, those are still really low. The rates are still really low. But I think we have to look at the fact that we have seen an increase in prices. We have seen equity levels return into the positive. We have seen, steady increases in average sales prices in markets across the country. Some have grown drastically. Some have been a little bit more steady. But when you look at the difference between, in a 3.5% interest rate and a 4.5% interest rate, there is a dramatic impact on what that means in terms of the end consumer, what they're accruing in interest payments. So why do we see rates going up? What is the reason for that, or what's behind it? So you got to look at the 10-year bond in terms of the Treasury, and so when those percentages go up, it has a impact on interest rates and the investors that are backing these mortgage rate securities, these backed securities, because there is a higher risk associated with mortgage-backed securities, and they want a higher return. So it's all very correlated with what's going on in Wall Street. But the debt is in the trillions. You're looking at student loan debt, just national debt. We're in the trillions. So these slight upticks in mortgage interest rates have a big impact on the economy. So that is why you're seeing activity a little sluggish. And that, in my opinion, is why you see, rates kind of holding a little bit in those mid fours and not making these drastic gains. We're just not in that boom or bust economy. The new normal, at least for the foreseeable future, has been replaced with slow and steady and not boom and bust. And a lot of that has to do with the national debt. All right, that's all I got for you today. If you got any questions, reach out to me, Jason at impactagentuniversity.com. Be happy to answer any of your questions, whether you're a consumer or a real estate agent trying to grow their business. Thanks so much for watching.